What's up, folks? This is Eric from Option Edge, and today I want to talk a little bit about covered calls, when to do them, when not to do them. So I'm using OKLO, this stock here, as an example. So OKLO is a modular nuclear reactor company. There's been a lot of pro-nuclear stuff in the news, so this stock actually has taken off the last few days. And someone recently reached out to me to ask how to play this thing. I'm not a stock picker, so I can't tell you to buy or sell anything. And so the stock's been pretty volatile over the last year. You can see we have an average true range that was in the below 1, and now we're at times over 5. So this is like 10% moves for a $50 stock. So that's pretty volatile. So you'd think that selling a covered call would be a good way to capture some of these volatile swings if you are a shareholder. So let's backtest whether over the last year or two, if the covered call strategy would have worked in our favor. And it looks like it would, after the stock maybe takes a run, you sell a call and get some shorter delta exposure rather than if you have 100 shares of stock, your delta exposure is 100. So let's go here. We're going to be short the 25 delta call. I have here, we're going to do a stock move of, let's go ahead and try a 6% stock move, or let's do 7.5 because we had an ATR of about 10% before. So let's see how this would react over the last 2 years. So a 25 delta call, you're going to win more than you're going to lose, but overall your return is going to be bad. So if you own 100 shares of stock, and then you sell a 25 delta call above that, that call is going to lose, and basically you would have been better off buying stock than doing a covered call strategy. So what this tells me is, let's try looking at the opposite end of this, and let's go long with a call. All right, so simply going long a 25 delta call after a large move up, a 7.5% move to the upside, is going to give you massive returns here in the past. Okay, so what does this tell me? This tells me that volatility is a bit mispriced. The calls should be more expensive. I can go into bar chart. I can look at OKLO's historical versus implied volatility graph. So what I'm seeing here, this is in about the last year or so. You can see here implied volatility in orange was a lot more pronounced than historical vol. Historical vol was pretty subdued. So around here would have probably been a good time to get short volatility because the realized volatility ended up being much lower than the actual volatility. But then if we move forward over the last 9 months or so, you can see that realized volatility was much greater than implied. So what this tells me is that volatility was mispriced here. Here it sort of comes back together, and then in the last couple months, this makes sense with, volatility was up over the last couple months with all the tariff talk, as you can see here, and it's been subdued a little bit. But now implied is sort of outpacing realized here. But overall, you can see that realized vol was much more than implied vol, and that kind of matches what we're seeing on the back testing. So this is a far out of the money call, and it's still giving us great returns, albeit only a 27% win rate. But at the end of the day, it's how much total return you're getting. So let's try one other thing. Let's see if we were to be directionally neutral. We're going to buy a 50 delta straddle, and we buy a 50 delta straddle, and I'm going to set only a profit target for about 20%. And then once we get to the halfway point, let's try 15 days, 30 DTE to expiration, see how this reacts. You can see even buying a call and put strategy gives us a pretty darn good return. We're directionally neutral. We're not even choosing a side. The option market is pricing these options too cheap for how much the vol has been. So this is a great summary of not wanting to do a covered call strategy because just the volatility has been too cheap. So if you sell that volatility, you want the volatility to be expensive.